Record mortgage debt sounds terrifying, but here's the truth. If you've been paying attention to the news lately, you've probably seen headlines saying things like, mortgage debt hits all-time highs. Americans drowning in housing debt. Is another housing crash coming? And honestly, those headlines sound terrifying. Because yes, mortgage debt in America is at a record high right now. But here is the problem. The headlines are missing one huge piece of context. And without that context, people start assuming we're heading straight back into another 2008 style collapse. But the reality of today's housing market is very different from what happened back then. And today I want to explain why mortgage debt is at record highs, why that doesn't automatically mean danger, what the media, of course, is leaving out, and why most homeowners today are actually in a much stronger position than people realize. Because this is one of those topics where fear gets clicks, but context matters. Hey everyone, this is David Hittle, your real estate specialist, doing business as Shop Kentucky Homes LLC with United Real Estate Louisville. And on this channel, we talk about real estate. We talk about housing market shifts, affordability, financial realities, and what's actually happening in the market here in 2026. And if you enjoy honest, data-driven housing content without all the panic and the hype, please make sure you hit that subscribe button and like this video. So yes, mortgage debt is at record highs. So let's start with the scary headline. Mortgage debt in the United States is now sitting around $14 trillion nationally. And that is an all-time record. And immediately people hear that number and think, well, that sounds horrible. But here's the thing. Of course it's at a record high. Home values are also at record highs. America has more homeowners now than ever before. Homes cost dramatically more than they did 20 years ago. And the total value of real estate has exploded over the last decade. So naturally, the total amount of mortgage debt is going to rise too. That part by itself is not surprising. The important question is not how much debt exists. The important question is how much equity exists compared to that debt. And that is where the story completely changes. So what the media is leaving out? Equity. See, the headlines, they're focusing on the debt, but they typically ignore homeowner equity. And right now, homeowner equity in America is also massive. Collectively, Americans own tens of trillions of dollars in equity in their homes. In fact, homeowner equity today is more than double the amount of mortgage debt. And that is a completely different situation than what we had in 2008. Back during the housing crisis, millions of homeowners owed more than their homes were worth. And that was the real danger. Because once home prices dropped, people had no equity, they had no cushion, they had no flexibility, and often they had no way out. And that is what created the foreclosure crisis. But today, most homeowners are sitting on substantial equity. And that changes everything. Today's homeowners are much stronger. And this is another thing that people don't realize. A huge percentage of homeowners today either own their homes free and clear or have over 50% equity in their homes. And that is enormous. And it means many homeowners are actually financially much more stable than those scary headlines suggest. Now, does that mean everyone is financially comfortable? Of course not. There are definitely people struggling with inflation, insurance costs, taxes, consumer debt, and affordability pressures. But from a housing perspective specifically, most homeowners today are not in the same dangerous leverage position that we saw before the 2008 collapse. And that distinction matters, and that distinction matters a lot. So why is today so different from 2008? When many people hear words like record debt or housing affordability crisis, our minds immediately jump to 2008. But there are several major differences today than what we see back then. Back then, lending standards were extremely loose. Risky mortgage products were everywhere. Many buyers had little or no equity. And speculative buying got completely out of control. Today, lending standards are much tighter. Most homeowners locked in relatively low fixed mortgage rates over the last several years. And many homeowners have built significant equity because home prices appreciated so rapidly after 2020. So while affordability is a challenge right now, this market structurally looks very different from the 2008 crash era. Now that does not mean prices can't soften in some areas. It does not mean that some markets won't struggle. But it does mean the underlying foundation of homeownership is much stronger than the headlines imply. Now, the real issue, if we're being honest, is monthly payments. The bigger issue in today's market is not necessarily debt itself, it's monthly affordability. Mortgage rates remain much higher than the ultra-low pandemic era rates. Insurance costs are rising. Property taxes are rising. Everyday living costs are rising. And that is squeezing buyers, which is why we are seeing slower buyer activity, longer days on market, more negotiation, and increased payment sensitivity. And that is the real story right now. Not some massive wave of underwater homeowners. So what does all this mean for buyers and sellers? What does it all actually mean? Well, for buyers, it means do not let scary headlines convince you that the housing market is automatically collapsing. Remember, real estate is local. Some markets are cooling. Some markets are stabilizing. Some markets are still competitive. And nationally, homeowner balance sheets are actually much healthier than many people realize. For sellers, it means pricing correctly matters more than ever because today's buyers are cautious. They're analytical, and they are heavily focused on affordability and payment. The days of simply throwing a house on the market and expecting 10 offers overnight are not automatic anymore. Your home's presentation matters, your home's pricing matters, and the marketing that your home gets and the strategy that your home uses, your realtor uses, matters more than ever. So yes, mortgage debt is at record highs, but so is homeowner equity. And that's the part that most headlines are conveniently leaving out. The housing market today certainly has its challenges. We have affordability issues, we have elevated mortgage rates, we have rising costs, we have slower activity in some areas. But today's homeowners overall are in a much stronger financial position than they were leading into the last housing crash. And that context matters, and you got it here. So if you are thinking about buying or selling anywhere around Louisville or throughout Kentucky or anywhere in the world, I'd love to help you navigate today's changing market. Or if you're watching this in a different area and are wanting to ensure you have a specialist in your corner, contact me as well so that I can introduce you to someone in your area that will treat you like I would treat you. And if you enjoyed this video, please make sure you click the like button, hit the subscribe button, and follow for more real-world housing market updates for 2026. Again, this is David Hittle, your real estate specialist, doing business as Shop Kentucky Homes LLC with United Real Estate Louisville, and I hope to see you in my next video.